This podcast is intended for investment professionals only. All investing involves risk.
Hello, and welcome to this edition of Elgin Talks. I'm delighted to welcome Nick Stansbury and Robert White to the podcast. Nick's our Head of Climate Solutions, and Robert, our Head of Active Equities. My name's Anthony, and I'm a Content Manager here at Elgin. Today, we're going to be discussing the crucial matter of climate investing, and in particular, what we mean at Elgin when we talk about climate action investing. Now, I understand that when investors are talking about climate investing, they actually might wish to reframe the way they think as they strive to meet both their financial and climate goals. So if I may start with you, Nick, how are many investors and business leaders traditionally framing the question of climate investing? And how is Elgin's Climate Solutions team's thinking on the topic different from this?
Thanks, Anthony. We think that investors and corporate chief executives and boardroom directors actually have much more in common with each other when it comes to this issue than I think they often suspect that they do. What do we mean by that? Well, we think that both inside investment committees and inside boardrooms today, the same tug of war is going on between two groups and two sets of interests who quite often, I think, see themselves fundamentally in opposition with each other. We can think of these two groups of interest almost as though they were two teams. On the one hand, you've got Team Climate, the group who understand the need to drive decarbonisation, whether that's as an investor when it comes to decarbonising your portfolio's emissions, or if you're a corporate emitter, decarbonising your direct emissions. And another group who are worried about profit maximisation. So in the case of an investor, that's return maximisation, and a corporate maximising profitability. And these two teams think of themselves quite often, I think, as though they're in tension with each other, tugging on different ends of a rope, where if one team tugs too hard, the other team has to tug back to bring things back into balance. And we think this expression of climate and profitability as considerations that are in opposition to each other, which have to be balanced off against each other in some way, is just fundamentally not supported by the evidence. Because when we look at the data, when we look at the evidence and the modelling, we think that whilst not in every single case, in the overwhelming majority of cases, companies are likely to maximise their long-term profitability by both maximising their exposure to the opportunities that the energy transition is going to create, as well as to maximise their potential first-mover advantage by accelerating their own decarbonisation today. So this is what we mean by cutting the rope, cutting the tug-of-war, and why we think it's really important to reframe the climate question. Because Team Climate and Team Profit interests are not in opposition. And in fact, Team Profit will do best when Team Climate does best as well.
Thanks, Nick. I love the analogy of that tug of war and the need to cut the rope in that tug of war if we're to reframe the climate question. So Robert, turning to you, if you had to define the term climate action investing for our listeners, how would you do this? And also, what do we see as the potential opportunity here for investors as they seek to meet both their climate and financial goals?
Hi, Anthony. Thanks. That's two really interesting questions. When it comes to climate action investing, what we're really talking about doing is trying to identify those companies which we think aren't currently decarbonising at the appropriate rate of change, and where we think that through a targeted focus on engagement, we would be able to encourage them to decarbonise at a faster rate, and that would help unlock shareholder value. So in contrast to traditional ESG investing, where we've tended to focus on businesses that are already Paris aligned, or where we think they're in sectors that are relatively low in terms of their carbon intensity, what we're trying to do here is identify those businesses that are in the high emitting sectors, and where we think that we can use engagement. And I think that's probably a nice way of segueing to your second question, which is that it's something we always get queried on when we speak to investors on this strategy. And it's around, as Nick mentioned, is there this tug of war? Well, I actually think the tug of war is what creates the opportunity for us here. In that for lots of companies, they've missed out on addressing this very significant opportunity of shareholder returns by feeling that it had to come at a offset to something else they might want to do in terms of maximising shareholder value. And in fact, we think these two, as Nick mentioned, are very closely aligned. And we think that encouraging companies to think in this way is a great way of supporting these dual objectives.
Great, thank you, Robert. Now, before we take a look under the bonnet of climate action investing, I understand, Nick, that LGIM's formed a key partnership with the Swedish pension fund, AP7. Could you please explain the nature of the partnership?
We first announced our partnership with Swedish AP7 a little over a year ago, but our discussions with them date back quite some time even before that point. And when we first started talking to each other, we became aware that we were both concerned about the same fundamental issue. And the issue we were worried about was that we could see increasing numbers of investors seeking, for very understandable reasons, to try and tackle their exposure to climate-related risk by taking money away from those companies that had the biggest mountain to climb in times of future decarbonisation. Now, there are all sorts of good reasons why investors might want to take capital away from and reduce their exposure to high carbon issuers in terms of reducing their own risk exposure to future climate-related risks. But we were both very concerned that taking capital away from those companies that need to invest capital in order to drive their decarbonisation was not likely to have the sort of real-world impact that we wanted to have. We think sometimes when talking about this of the analogy of a householder needing to put solar panels on their roof to decarbonise their household, something that many of our listeners may have thought about doing. And what you do when you put solar panels on your roof as a householder, as a homeowner, is very similar to what a company does when it thinks about decarbonising its emissions. We spend quite a lot of money up front. You capex, you invest up front many, many years worth of your utility bills in order to generate a relatively modest saving every year and for a very large number of years to come in terms of a reduction on your monthly outgoings on your utility bill. You invest lots up front to reduce your future OPEX, your future operating expenditure, and drive decarbonisation. And it strikes us that telling a householder that they need to decarbonise by investing money and then taking money away from them and making it harder, for example, for them to borrow money from the bank to fund that project isn't going to help them to find a way to find the money to invest to drive that decarbonisation choice. And for the case of listed companies, exactly the same dynamic is in effect. And it's this concern that actually we need to be leaning into and proactively engaging with and choosing to allocate incremental capital towards those companies that have the biggest decarbonisation mountain to climb that underpins our partnership together. Because both of us are motivated by these two twin objectives, not only seeking to unlock financial value from the energy transition, but also having as big an impact as we possibly can on accelerating the pace of real-world decarbonisation.
Thanks, Nick. I really love the analogy of talking about solar panels. I'm sure a lot of our listeners can relate to that balance between wanting to invest the capital up front versus wanting the long-term potential for a reduction in utility bills that solar panels can potentially bring. So I think that helps to talk about that parallel. And thanks also for talking about the partnership with AP7. It's good to hear the alignment of values there. Thinking now primarily from a climate perspective, why do we see a need for investors to take a more active approach?
Great question. So when we look at listed companies, and that is those companies which fall really directly under our zone of control or zone of influence as public market investors, we see that listed companies make up somewhere between 40 and 50% of all direct CO2 emissions globally. In other words, listed companies make up roughly half of the world's decarbonisation problem. And what we should see when we look at listed company emissions is that they should be going down at somewhere between 6 and 8 percentage points every single year if we were on track for meeting the Paris goals and be on track for realising a net zero carbon world in or around 2050. But actually, when we look at the data, and we go back at least over the past decade, we can see that there's only one time period in the past 10 years, 1 year alone, where listed company emissions have gone down by anywhere close to that amount. And that was during the COVID pandemic. Over the past decade in aggregate, emissions from listed companies have barely declined at all. And this is creating, we think, for investors, two issues. The first is it is raising and increasing the size of the systemic risk that failing to decarbonisation will create for the world, and therefore for us as investors, in terms of destabilising the global economy and threatening and imperiling future returns, not just from equities, but potentially from all asset classes. But we think it is also creating a significant misallocation of capital. Difficult to work out exactly how big this misallocation of capital is, but we've had a go at quantifying it. We've put some of our calculations in the white paper that we've recently released. We think that misallocation of capital is worth something in the order of magnitude of between $200 and $300 billion a year by around 2030. And it's these two issues, the creation of a systemic financial risk, as well as this misallocation of capital, that we're seeking to tackle with this strategy, both accelerating the pace of real-world decarbonisation by engaging with these laggards, these companies that aren't doing enough to decarbonise, whilst also seeking to tackle that misallocation of capital, thereby creating real financial value for our clients.
Thanks, Nick. Some great stats and real food for thought there, I think, for our listeners. So turning back to you, Robert, could you talk us through the method we look to employ to reduce the emissions for investors while simultaneously seeking to target returns?
Yes, as I mentioned earlier, we've tried to differentiate the way that we approach this challenge by looking to identify companies which are in the more carbon intensive sectors and where we think that they will be able to be proactively engaged with to identify businesses which can do more from a climate perspective to create this shareholder opportunity as well. So this dual objective that Nick talked about. And I think it's really interesting when you talk about the carbon mounting decline, in that when you do look at these companies which can have a significant impact on our ability to decarbonise at a real world level, the very significant majority of these, and as sort of obvious when you think about it, these are those carbon intensive names. So really being focused on what we can do to maximise what these businesses can do is about unlocking that solution for society overall. So what that means at a portfolio perspective, and when we approach this question, we're much more focused on identifying businesses which are currently poorly aligned, which if we were to make them aligned, that they would be able to be material in terms of reducing real world emissions, and where we think that successful engagement would unlock, or the potential to unlock, shareholder value going forward. And really, finally, it's about also thinking about, does this business have financial resources to be able to achieve these ambitions? So as Nick mentioned, it's very significant capital required to be able to support the decarbonisation pathways, and making sure that we're both supportive of these businesses and able to help them make better capital allocation decisions so we can deliver these objectives is really key in terms of our overall investment process.
So just picking up on some of those practical things that we believe companies can do, I understand there are 5 levers that companies can pull potentially as they seek to unlock value from the energy transition. Could you maybe talk us through some of those, Robert?
Yeah, so we've identified essentially 5 levers, which we don't think will apply to all companies, but we think broadly a climate shareholder upside will be able to map to one of these levers. So when we look at companies and try to assess their potential, we're really thinking about it through the lens of these levers. And the first lever is revenue growth. So when we think about the very significant change required by society overall, we think this will create many opportunities in terms of the investment that needs to be made. So we think there's a clear opportunity to identify these businesses which can support that transition and maybe aren't currently doing all they could to support that transition. And through active engagement, be able to identify in their own capital allocation framework opportunities. We also think that there's potential to be bifurcation within sectors. So there'll be winners and losers around those companies who are able to lean into the opportunities to reposition themselves relative to their peers, recognizing the challenges that the energy transition overall may have to their current business model and the need to demonstrate innovation within it. We think for lots of these businesses, there'll be a clear opportunity to get a first mover advantage and a shareholder moat, which we think can be enduring in many cases. One of the other levers would be around OPEX opportunity and how this manifests in terms of superior margin going forward. We think businesses that position themselves quickly around what they can do to mitigate the negative effects of the energy transition will be able to pass on less of that cost to their customers going forward. So we think it's really important to find these businesses where moving early in relation to the transition allows them to lock in more of that value for shareholders. We also think about green premium. This is where you're able to sell a product at a higher price relative to its alternative due to the sustainable characteristics that product may have. So the easiest example here is something like green steel in the US at the moment. We're able to see that steel which has a lower embedded carbon trades at a premium to steel which is made through traditional methods. And that's responding to customer need, where you've got customers looking to address their overall carbon position and are willing to pay more for a product which has less embodied carbon in it. The fourth of these levers is around a lower cost of capital. And we think that companies which are acting now to offset the greatest risks around climate means that the advantage around lower volatility of returns will be greater going forward. So a really easy way of thinking about this is something like a business which is exposed to increased weather effects. And that means that when you're seeing more volatility in returns in year, by mitigating your exposure to that, you're able to offset that in terms of the impact it would have on the volatility of the returns you make. You get a lower cost of capital relative to your peers. And then finally, we think about risk avoidance. And this is a really important one for us in that we're looking to identify where businesses need to act to avoid the worst aspects of the climate crisis and the impact it will have on their overall business models. As active owners, obviously, we're looking to make sure that this risk is not appropriately or is appropriately priced in the share price going forward. And therefore, it's something where we can look to mitigate. And if we are able to successfully mitigate, get an increase in the value of the share price relative to what was expected by the broader market. So I'll probably leave it there in terms of those 5 areas, but those are the key things we look at in terms of trying to identify those opportunities.
Thanks, that's some great insight into those tangible steps. We've time for just one final question. So, Nick, if you had a single overarching message that you'd like to leave with our listeners, what would it be?
That you have more in common and your interests are more aligned with the directors of the companies that you invest on this question than you think they are. Maximizing long-term returns is not going to require, we believe, giving up on climate considerations, nor is maximizing a company's exposure to the opportunities that the energy transition is going to create, going to lead to the companies in which we invest being worse off over the long term. But patience is required. And over the long term, we believe that we can take action on climate and unlock financial value for our clients in the process.
Nick, Robert, thank you both very much for your time today. And thank you also to you, our listeners, for tuning in. If you'd like to read more about climate action investing, you'll find the link to our latest climate white paper in the show notes below.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal & General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law, or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.